3-minute trader's tip. Why is the last hour of the trading day important? Now, there is an old market saying that the amateurs open the market and the professionals close it. In this video, we're going to look at what that means, the relevance of it now, and of course, what that may mean in respect of your behaviour. The suggestion behind this saying is that most amateurs are so enthused and keen to rush in their orders at the opening bell that they dive in, whereas most professionals abide in their time, wait until the dust has settled, and are placing their orders in primarily the last hour of the trading day. Now, this is somewhat simplistic relating to the trading actions of market participants because it is always active, and the proliferation of high-frequency trading, retail investors, and EAs may have altered this to some degree to what it once was. Nevertheless, theoretically, there are, however, some advantages with the last hour trading that remain logically beneficial. So let's have a look at those now, and then you can make your decision as to whether you're going to integrate this into your trading or otherwise. So let's look at the first of these, which is maturity of price action. Many entries are based on a specific move above, if we're trading long, a specific price point. There is more certainty that this may be the case as the trading day draws to a close. It is more likely that in the last hour something is actually going to close over a resistance level, for example, than perhaps if it's trading above that level in the first hour. Additionally, of course, there is candle maturity. So it can be fairly certain if we have a large green candle trading towards the top end in the last hour, then it is more likely to stay in that vicinity. Whereas at the start of the trading day, there's no such certainty. Much can happen during the course of the day. And indeed, we often see long wicks and small bodies created by the end of the trading day, which suggests that maybe there isn't the buy-in pressure that that larger green candle would indicate. Point 2 is related to this, of course, as many indicators are based on price action. And if logically this is the case, and the above is the case as well in terms of getting maturity of price action in the last hour, then the same can be said for indicators. So for example, your moving averages have crossed and your volume is clear as to whether it's been higher or lower than the previous day, or higher and lower than is average, which may be part of your criteria for getting into a trade. Of course, there's always the danger of gapping when trading shares or share CFDs. By the end of the trading day, we're not actually that far away in Australia when trading the ASX from European market open. So we sort of know what that's going to do, and also we have a more mature situation in terms of what the US futures are doing, along of course with any commodities for trading stocks within the material sector, and how they're doing throughout the day. Clearly, the more information we have, the better place we are to manage market risks, and that includes the risk of gapping. So these 3 key benefits are of course logical. Now, the choice is yours. What you need to do is decide whether your primary trading action is going to be in the last hour, or indeed, if it's during the course of the day, what signals inside the day's trading will be useful in terms of you making a decision as to whether to enter a trade early. And of course, whatever you decide to do, you need to articulate this in your trading plan. Trade safe, and we'll see you again soon. Bye bye for now.